more minutes, okay? All right. Okay, so part 3, because you can't get enough. One thing when you're doing currencies is, just like when we talked about the different subsets of provisions, there's different subsets of currencies. These are the 3 types of currencies you really need to make sure you're talking about. So, and not all 3 of these necessarily are relevant. I always think when I show this on the screen, you guys think it's like a shot clock. It'd drive me crazy if I don't look at that. So there's local currency. So local currency is when you file your tax return, when you file your financial statements locally, what currency do you use?
Local.
Well, U.S. if you're in the U.S.
Local, right? When you file a tax return in the UK, you think they want a return with dollar numbers on it? Right. They're like ugly American, right?
More tax.
Okay. So think about it from the perspective of the consumers of the local data. What do they want? They want local currencies because they work in local currencies. Okay? Functional currency is the currency that you operate business in. Okay? So if you're selling to customers and you're selling in pounds and you're paying your vendors in pounds, your functional currency, probably pounds. Right? If you're in the UK and you're selling in dollars and you're paying your vendors in dollars, probably dollars. Okay? So your functional currency is important because that's what you keep your US GAAP books in. And then you translate from there through CTA. But that currency is a function of how you operate. Okay? And some companies, it's very clear, they operate in the local currency. So local and functional is the same. Right? You're in the UK, you're dealing with UK customers, they don't want to pay in dollars, they want to pay in pounds, right? Your vendors, they want to be paid in pounds, right? You're a UK functional currency. The reporting currency is whatever currency you put your 10K in, right? So it's entirely possible that these 3 could be all different currencies, right? And from the fact that there are different currencies in these 3 buckets, out will come problems that you need to solve. Because obviously if everyone was in the same currency, like we were talking about with my other silly example, it can't be foreign currency, right? But if any combination of these are different, that's where the currency differences will arise, and then you need to isolate on what is the difference and what does it mean to me. Okay? So we haven't gone through this example, but let's say that you're US and you're UK, and let's say that you do business in dollars in the UK, okay, and you make $100 of profit, and you think that you owe $28 of tax, and I think we did actually touch on this a little while ago. And let's say that the UK gives you a long time to file your tax return. You file your return, you pay the tax. It ultimately ended up being that you paid $30 of tax. When you take the pound number that you cut a check for later and you translate it back to dollars, so then what is that? Right? So in dollar terms, you need to credit cash 2. You paid 2 more than you already accrued. Right? What do you debit?
Oh, that's good answer, good answer.
CTA,
It's an exchange gain or loss. Right?
Last time I said that, you said no.
It's P&L. And it's just like as if you had any other asset that got changed. This is not provision P&L. This is just P&L, right? So you could have had a bank account that's sitting in, Brazilian real or something, and the currency's moved. And just because that asset translated to a different rate, that's an exchange gain or loss. So that's a P&L item. And all that happened here was you had a non-US dollar, right? Because you're a US dollar company, but you had something that wasn't dollar that you had a transaction gain or loss on because you settled up and in this situation, you had a loss. Okay? And the reason that became relevant is because the local currency was different than the functional currency. Right? And so out of that came something you had to deal with and you need to book an effect for. Okay?
Are we still just dealing on the UK level, and we're not like this? Are we still in the US on the
No.
reporting side, or we just?
That's all. We're all talking UK at this point.
We're all talking UK and what's going on there, and two first ones there.
Right.
Okay.
But by contrast, like if you went back to this situation, right? This is our Lena, we have money in our foreign sub and it's translating. And it's causing foreign currency issues. Right? If you go back to this page, well that's because the functional currency of that entity was pounds or euros or whatever I called it. But the reporting currency is dollars. So they're different. That difference creates the effect. With the effect, we need to know what the tax consequences are. So the best way to isolate on currency differences is know the 3 different currencies and figure out where the differences are. When you know the differences, you can identify the fact patterns. Okay. So I have some simple slides that talk about translation, remeasurement, and transaction, but I think we've covered this. I hope it's easier to follow when I scribble than when I go through the canned slides, but you can decide that for yourself. You can reread the canned slides on your own. Yep.
You know, in your example, you're using $28 and $30, but what if you're working with like 28 million and 30 million? Will companies, when they're doing that type of exchange, would they hedge their bets by buying like foreign currency? And if they do, how would they book that?
Well, if there's one thing that tax people don't understand more so than foreign currency, it's hedging foreign currency. Yeah, that's complicated. Yeah. I'm going to leave it at that. You know, what you see at companies is some companies hedge, other companies don't hedge. And, you know, I'm no treasury expert, and it's interesting to me when I see the different companies I work with when they do and don't. I mean, I was working with one company for a while that got acquired, but they were hedging all over the place. In fact, I was convinced they were hedging their hedges. And it just took me so long to sit there and map out what economically was happening. But really the only way to process that is to slow down and know what the transactions are and what the impacts are. But hedging it's unbelievably hard to follow for me. So this is another one that we'll touch on actually on the December 6th session. I think we cover this. So sub F and PTI. This happens. This comes up pretty frequently. Okay, so let's say that you have U.S. and foreign sub, and let's say it had $100 of profit, and it's equal to 100 euros, and you have a deemed dividend. It's sub F because it's all interest income, let's say. So they picked up on their U.S. taxable income is $100. Okay. So that's what happens on day one. So now, day two, we're still sitting on our 100 euros. Money hasn't moved, but now it's worth $110, and we decide to actually distribute the money. Okay. So what happens? What happens in that case? So this sub F creates PTI account. PTI stands for previously taxed income, meaning we had this income and we were taxed on it in the US. So now by the time we get over here, it's been previously taxed, right? It's pretty basic. But our PTI account is measured in dollars equal to what we picked up on our U.S. tax return. It's $100. So if we received a distribution of $100, then we would have no U.S. taxable income because we just take it out of our PTI account. It's almost like return of basis, right? But in our situation, we're going to say the money we're going to get back is actually worth $110, right? So we have a $10 income pickup. And that income pickup is the 4x gain on your PTI account, right? So that's a good double acronym. So that's governed by Section 986. And so if you had that situation, which again is not infrequent, you'd have to say, well, what am I going to book for that? Right? I obviously need to credit my payable because I'm going to have to pay tax on that gain, and I need to debit something. Okay? And this is complicated. If you were not permanently reinvested, you would book that tax effect to CTA. Because all that is translating the foreign earnings. It's the same thing as the Lena example earlier, except instead of just a dividend of that money or a return of the money, now it's a PTI thing. So if we said, no, we're not permanent, that money's coming back someday, and we should just tax effect that to CTA. A lot of companies just forget this even exists. So they think, PTI account, I even have one of those. The provision person doesn't know what the PTI account is. That's an international tax thing, right? And so unless the international tax person said, I have a PTI account, it's denominated in dollars, but the underlying cash is in a different currency and there's translation effects, and I'm going to have a 986 gain, which your international tax person will almost never volunteer, just because they don't know to volunteer it. But if they told you that, you would think, oh, I might have a tax effect of that. I should think about that. But that conversation rarely happens. So oftentimes what people realize is that, upon a payment, I realize I have this. And then it makes me wonder if I should have been booking a DTL all along for that effect, because I knew it was coming. That is the issue. And that happens frequently. Like, people will make a distribution, they'll say there's a 986 gain, and you'll say, well, how did that foreign currency gain accumulate? And they'll say, over the last 5 years, I had this PTI account. And somebody will say, well, why didn't you accrue the tax effect over the last 5 years? And the person's like, I don't know. And then the answer will be like, well, I'm permanent. I'm APB 23. Well, maybe. But if you step back and you think, why would you ever be permanent in a PTI account? You've already been taxed on it. Why would you not bring it back? Right? Using the John Chambers thinking, right? So that's a hard one sometimes. There's no black and white answer on that, but oftentimes that becomes an awkward conversation because it's not logical to be permanent on something that's usually tax efficient to return. Okay. So that's 986. Okay, so I think I'm going to stop. Surely you've had enough.